These are a few of the most popular ETFs, which is a type of fund. I'll explain the different types of funds in just a minute, but these are a few of the most popular types of ETFs on our stock market. Now, I'm not telling you what to invest in. I'm giving you these as an example, and I want you to remember that investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. So now let's go through this. This is a fund, VTI. This is an ETF that gives you exposure to the total stock market. So now when you go out and you invest in one share of VTI, and you can do this on pretty much any stock brokerage, now you're buying a little bit of pretty much every company on the stock market. So with this one ETF, you're essentially buying the American stock market. Then you have SPY. This is one ETF that gives you exposure to the S&P 500. Just a second ago, I showed you a stock chart. This was a stock chart of the S&P 500. The S&P 500 is an index, meaning a group of the 500 largest companies on the stock market. So now when you go out and you invest in a fund like SPY, what you're doing is you're buying a little bit of the 500 largest companies on the stock market. So now if one of those companies in your fund goes bankrupt, this fund will automatically kick that company out and put another company in. Then you have funds like DIA. This is an ETF that gives you exposure to the Dow Jones Industrial Average. This is one of the most popular and the most well-known and one of the most historical types of funds out there. The Dow Jones Industrial Average is a group of 30 different types of companies on our stock market. Then you have funds like QQQ. QQQ gives you exposure to the NASDAQ 100. If you've ever heard of the NASDAQ before, this is another very popular type of fund, and this gives you exposure to some of the largest non-financial companies on our stock market. That's why for the last couple of decades, QQQ has been very popular and heavy on the tech side of things because tech companies have grown so big, but this gives you exposure to the NASDAQ. And then you have things like SPYD, which gives you exposure to dividend-paying companies in the S&P 500. So for those of you who are like me and you like investing for cash flow, this is investing in companies that are paying dividends but are a part of the S&P 500, meaning it's one of the 500 largest companies in the stock market. But the goal here is to invest in companies that are paying those dividends, meaning cash flow, meaning now you're getting paid every quarter just for owning these companies as opposed to trying to see that price growth with the companies. And that's a little bit more advanced. I'm not going to be getting into what is a dividend, how to invest in dividend paying funds and companies in this video. I'm going to be focusing more on the fund side, that we understand that there are different ways for you to be investing your money. Now, what you want to understand here is that the way that you make money, the way that you actually see the most success as an investor in these types of funds is not by going out and putting $1,000 into one of these funds and just letting it sit there. The way that you actually build wealth with these types of funds is, number one, you want to make sure your investments are consistent. Number two, you want to make sure your investments are passive. And number three, you want to make sure your investments are automatic. I like to call this CPA, consistent, passive, and automatic. And what this means is now every time you get paid, whether it's every week, every 2 weeks, or every month, you want to have a CPA, consistent, passive, and automatic system where every time you're getting paid, some of your money is automatically going to be invested into your portfolio of funds. For me, I have a system where every Wednesday, cash leaves my checkings account and is automatically invested into my portfolio of ETFs. Now, I invest in ETFs that give me exposure to value. I have ETFs that give me exposure to dividends. In fact, dividends are the largest fund piece in my portfolio of funds because I like cash flow. I have ETFs that give me exposure to emerging markets. These are companies and countries that are overseas that don't rely on the dollar. And I have ETFs that give me exposure to innovation. That's a smaller piece of my ETF pool because, well, that's more risky and that's kind of more on the fun side of things. This happens consistently, passively, and automatically. It doesn't matter if the market's going up or the market's going down. It doesn't matter if the market's booming. It doesn't matter if the market's crashing. This is going to keep happening, and this is happening for the long term. This is not something I'm doing for 6 months or 6 years. This CPA method of investing in these types of funds to build wealth is something you need to plan on doing for decades. That way you can build true freedom through the stock market. Now, you got to figure out how much money do you want to invest in stocks, how much money do you want to invest in real estate, how much money do you want to invest in your own business. But if you're getting paid, like I own Briefs Media, that is my company. I'm the CEO and I run that company, but I get paid a salary out of that company. Now, out of the salary, a big chunk of this is being CPA'd, consistently, passively, and automatically invested into my portfolio of funds. So whether you are just an employee or a business owner, this is the way now for you to take the income that you're making as a worker, because I'm a worker as well. You take this money you're making as a worker, and now you can invest a piece of this into these funds. That way you can build this long-term wealth. You have different types of funds for pretty much anything that you can think of. Like you have funds for all the things that I just talked about. You have funds that are specific to real estate stocks. You have funds that are specific for healthcare stocks. You have funds that are specific for dividend-paying companies. You have funds that are specific for technology. You have funds that are specific for specific countries. Once you know what it is that you want to invest in, well, now you can go out and start investing in these funds. But you also want to be cautious about spreading yourself too thin and creating a portfolio of 45 different types of funds. Start simple, start small, understand what the bigger funds are, understand what you want to invest in, and then start investing your money, and just don't dilute yourself too thin. Now let's talk about the different types of funds there are, because I think this is important for you to understand, because what ends up happening to a lot of people is they start investing their money into the funds, but don't understand now how much these funds are actually costing them. And in case you're wondering, what does Briefs Media do? Well, we are a financial news and education company. We have some really cool products, one of which is Market Briefs. Market Briefs is our free financial newsletter, where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read email. You can read the email in less than 5 minutes every morning, and it's completely free. And not just that, I promise that you are going to love reading Market Briefs every morning. And if you're wondering, but Jaspreet, how can you promise that I'm going to love reading Market Briefs? Well, if you don't love reading Market Briefs, you can unsubscribe at any time because it's free. So if you want to join Market Briefs, I got the link to how you can join down in the description below, where you can go to briefs.co/market. That's briefs.co/market. Now, when it comes to the different topics of funds, you have 3 general categories of funds. You have mutual funds, ETFs, and index funds. And the 3 main things that you want to pay attention to when you're understanding the difference between these are, number 1, the fees. Number 2 is how often you can trade out of these funds. And number 3 is, are they more actively or passively managed? And I'll explain what all this means. So starting with mutual funds, the thing that you want to understand about mutual funds is that mutual funds are generally more actively managed. And what that means is there is generally a person behind the actual mutual fund that's making the trades in and out of this mutual fund. So now, because there's a person sitting here and managing the trades, managing the companies inside of the funds, the goal is that this person will be able to outperform the market, outperform an algorithm or a computer, but you're going to have to pay this person higher fees. So the fees are generally higher because now you have to pay for that person. And mutual funds generally have this trading limit where you can generally only trade in and out of a mutual fund 1 time a day. Now, whether or not you want to invest in a mutual fund is really going to be up to your discretion. But what we have seen is generally these types of mutual funds, when you factor in the fees, can generally not outperform the market for a long enough period of time. But sometimes there will be some mutual funds that, even despite the fees, will be able to get general higher returns. But that risk really now comes down to you. And I'm not going to kind of go into how do you analyze mutual funds and what's a good mutual fund or not in this video. But I want you to understand that mutual funds have generally higher fees. And for some or most mutual funds, these fees are not worth it. But in some instances, they will be. But I want you to start thinking about that. Is that fee worth it or not for you? Because my goal is not to tell you what to invest in. My goal is for you to be a financially educated investor, that we can find good investments that fit within your portfolio. I'm going to skip over ETFs for just a second, and I'll move to index funds, because index funds are a little bit different than mutual funds in that index funds are generally passively managed, not actively managed, which means that there's generally an algorithm or a computer that's managing these funds. So just a second ago, we were talking about the S&P 500. The S&P 500 funds are generally passively managed, meaning there's no person that has to sit there and manage the 500 largest companies every single day. It's managed by an algorithm. And when a company falls out of the S&P 500, this algorithm will kick one company out of the fund and put another company in. So it's a lot easier to manage because it can be managed by a computer, which also means that the fees are also lower. So it's generally not something you have to think about writing a check for, but it's something you want to be thinking about, because if these fees are high, they're going to be eating a piece of your profits and you're not even going to be seeing it happening, which is actually what a lot of Wall Street wants. They don't want you to think about the fees, but I want you to think about the fees, because these fees can add up. A 1% fee over the course of your investing career can eat up more than a quarter of your total investment profits. which is why you got to understand that this 1% fee isn't just a 1% fee one time. It's a 1% fee on every single dollar that you invest and every single piece of profit that you're going to be generating for the course of investing career, which is why I want you to understand the importance of these fees. And also when it comes to trading with these types of index funds, you can generally trade these index funds only one time a day. Now, ETFs are a nice little hybrid between mutual funds and index funds, and that you can trade these just like any other stock. You can trade in and out on ETF as many times as you want. They trade on the stock market just like any other stock. And these can be either high or low fees because they can be actively or passively managed. What you'll see is that you'll have ETFs that are mutual fund based ETFs and index fund based ETFs. So you'll see ETFs that are more actively managed and passively managed. Some will have higher fees than others, some will have lower fees than others, but you can trade in and out of an ETF just like a stock, which kind of gives you a lot of ease with an ETF. So you got to figure out what's right for you. None of these is necessarily better than the other, but you want to understand the different investing options out there. That way you can make an educated decision when it comes to you going out and actually investing your money. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.